The next session is going to be on technology in financial services, and we have a very distinguished panel of speakers for this session. The session will be chaired by Mr. Vinod Rai, former Comptroller and Auditor General of India, and distinguished visiting research fellow of ISAS. And joining him on the panel would be Mr. Ajay Tyagi, Chairman, Securities and Exchange Board of India. The next will be Mr. Sopnendu Mohanty, Chief FinTech Officer, Monetary Authority of Singapore, and Ms. Anne Lochoff, Senior Advisor, Partnerships, Global Center of Technology, Innovation and Sustainable Development at United Nations Development Programme.
Thank you, ladies and gentlemen. Thank you for hanging in there, because I can see a lot of spectator fatigue. This is the 5th session, but I can assure you this is the penultimate session, so you have just one more to go. And after that lovely, scintillating session on youth, I think we are going to be very drab. But I can assure you, you won't see youth, but we also are post-youth. So somewhere down the line, okay, minds are very young. Minds are very young. Okay, that's absolutely. So we also can innovate, and as I think, who was it, Roshni or somebody who said that, look, it's not age that matters. Age is only a figure. So I think Anne has got. So we have an excellent panel today to deal with the subject of technology in financial services. And considering that we are running short of time, I don't want to give much of an introduction. We will spend about 7-8 minutes introducing your subjects, and then we leave it to the audience for whatever they have to. May I call upon the first speaker, Mr. Ajay Tyagi. Ajay is a chemical engineer. He did his master's in public administration from the Harvard University, and has been with the civil services. He spent a lot of time in the finance ministry in Government of India in dealing with capital markets. And I think poetic justice was done to him. He was made regulator of capital markets. He is chairman of the Securities Exchange Board of India in Mumbai. I must thank Ajay because he's flown in this morning only for this, and he goes back tomorrow itself. So thank you very, very much, Ajay. Floor is all yours.
Thank you, Mr. Rai, and ladies and gentlemen. The topic is quite wide, on the financial sector, FinTech issue. So I'll keep my talk to the capital markets, because that's what my remit is right now. Now, put in perspective, securities markets have kept pace with the technological changes over time. And in India, over a period of time, briefly, if I may say, to start with, like trading shifted from open outcry to screen-based electronic trading way back in '94. Demat of shares was started in middle of 1990s, and almost all shares are dematted as of now. Some of these activities much ahead of what happened even in the developed countries. Clearing and settlement, we achieved T+2 in 2003, and cross-market surveillance systems which we developed in-house in 2007. Recently we allowed interoperability of clearing corporations. So all these are innovations in which technology has been used successfully all along. Now coming to the fast changing landscape, the new technology usages, right now onboarding of clients happens online registration and through eKYC, the robo-advisory services, the applications of AI and ML and the potential to further use them, application potential of distributed ledger technology. So technology has been used, as I said, in the last many decades, and it is for regulators to keep pace with what is changing in technology. Now, in that, SEBI's approach has been that regulators shouldn't come in the way of innovation, but should continuously improve capacity building and learning, aware of the possible associated risks and as to how to manage them. Regulations should be technology agnostic and not tech prescriptive. There should be robust cybersecurity policy. SEBI already has it based on IOSCO principles. We also have a sandbox for innovation, We are coming out soon with regulatory sandbox 2. And we have a committee of experts which advises us on financial and regulatory technology. Some of the big IT projects which SEBI plans is to go for its own private cloud. It intends spending around 5 billion rupee the next 5 years. And we have a NOC-SOC, which is the implementation, and a data lake, which we want to improve our surveillance system for big data, processing of structured as well as unstructured data, AI, ML, and deep learning, analytical capabilities, pattern recognition, text mining, natural language processing, etc. Now, some of the broader challenges which are not restricted to SEBI alone. One is the data localization and data privacy issues. As you're aware, globally, many data localization and privacy laws such as GDPR have come into force. In India, draft personal data protection bill is being finalized, and as I learned that it's likely to be introduced in this coming parliament sessions beginning next Monday, the coming Monday. And other issue which I want to briefly state are cross-border challenges. Now with the single-click funds and securities flow across the world in just few microseconds, technology enables setting up of complex global structures with ease. Concerns of money laundering, round-tripping, and tax evasion, etc. remain. Transactions for fraud evasion, planned, structured at global level, but data is available with regulators at the local level. And what seems to be happening is that while information exchange between global regulators and governments is not as easy and free-flowing as it is to structure such transactions, thereby creating enforcement problems. So these are both basic issues which I thought I'll just bring out for this discussion. Thank you.
Thank you, Ajay. I think you brought out some very interesting issues, and I'm sure you'll be taken up on the sandbox on innovation, the sandbox on regulatory issues that you have devised. Anyway, we leave it to the audience. I will now call upon Mr. Sopnendu Mohanty. Sopnendu is some kind of a FinTech wizard. He's been working with the Monetary Authority of Singapore, and he has been recognized internationally as a FinTech thought leader, and he was recently named the Market Reformer of the Year by the IFL Euromoney. So we are very fortunate today to have Sopnendu with us. And Sopnendu, the floor is all yours.
Thank you for having me. And we just concluded I think the way you think about FinTech, and I would anecdotally say how life has changed. We just concluded a FinTech festival, and I don't know why 60,000 people decide to find some interest in that program, which clearly shows how FinTech has become a mainstream narrative for the last few years. And if you look at the festival, 40 people from Afghanistan came to attend the festival, which clearly shows that it became a mainstream and a real need serving area for all of us. And there are people who are coming to this area and solving real need for the society. And that's just very humbling for all of us to see how FinTech has evolved from 2008 after the post-global financial crisis, and then how FinTech has evolved for the last 19 years is something which I'd like to share with the audience here. If you take 2008 to 2015, most of the FinTech narrative was around this notion that banks are lazy, they're doing nothing about serving real customer need, let's replace them, let's disrupt them. That's the big narrative for till 2015. And that's primarily started post-global financial crisis, where banks started withdrawing from the credit market and FinTech started getting into that market. Which is fine. In fact, that triggered a different sense of how financial sector should be reconstructed, reimagined. But something interesting happened in Asia in particular. Post-2015, the narrative shifted. And the whole narrative of being disruptive shifted to being collaborative. And in Asia in particular, that the new wave of FinTech which came in, and the net result of that change is that if you look at the investment number in FinTech in 2019 till date, 80% of the global investment on FinTech has gone to fintechs who are collaborating with the financial institution. So there's a clear shift on the narrative and the investors following the narrative to where the purpose of fintech being served. Why Asia changed that narrative, which is something interesting to examine. Primarily because large market like India started thinking about fintech as the way to solve larger problem of inclusion. And if you look at India's stack story of Aadhaar and the UPI rails on top, it started thinking. You start thinking about there's a need for a public good to be in place to drive the fintech to the next level. And India itself, all of you know that the whole India stack generated 1.2 billion, and High Commissioner here, maybe he'll correct my number, but 1.2 billion have got an identity, and 300 million plus new accounts were created, which clearly showed that fintech can make a big change to society in terms of getting people included. In Asian market, if you look at the ASEAN itself, almost 80 or 90% of fintech today are helping the banks to digitize. I use the word unbanked banks. You think of an unbanked population, there's something called unbanked banks. There are many financial institutions in Asia, small cooperative banks, the tier 3, tier 4 banks who don't have access to digital tools and services. What fintechs are doing nowadays, they're creating new tools using APIs, cloud-based computing, and other such new way of doing things, and they're plugging into the old legacy systems of these banks, small banks in those markets, and trying to get them to the digital journey. What is the impact? These banks are, instead of becoming irrelevant, are started becoming relevant to the society to which they're serving. And that's a very positive sign, because that really brings the financial institution we're regulated to be starting getting relevant to the population who feels there's a need for banks to rethink their role in the digital economy. So that's a huge trend shift, which I think was good for regulators, because they don't feel that they have to go and regulate fintechs because that is growing. Now fintechs have changed the angle, they're going to part of the banks. That's a good thing for regulators to be happy about, so that they're not worried about the new kind of shadow banking growing. There's also something interesting happened in China. In 2015, when I met many fintechs from China, everybody said, I'm an AI, I do big data, I run on cloud, and there are 1,500 P2P, peer-to-peer lenders which popped up in China between 2015 and 2016. You go back to China now, there are only 50 left. These are the peer-to-peer, what we call as the new type of lenders. It clearly showed that the market corrected itself. That when you are not regulated, you bring a market risk, and the process of getting to hypercycle and get corrected is quite evident in China, because most of these peer-to-peer lenders start getting bankrupt, they're losing their way out, and they're back to the regulatory remit. And go to China, they put new regulations in place. I think that's a regulatory corrective action being taken in the market to bring the unregulated players back into the regulatory supervision. Now, if I have to paint the next 10 years from now, next 5 years from now, there's a new area fintechs are going to play a role. There are 3 big areas they're going to play a role. Micro pensions, the pension gap. By some estimate, by 2050, we are looking at an $18 trillion pension gap, and close to 1.5 billion people who have unmet pension need. And that is the area a lot of fintechs are going to get in, because there's a concept called micro pension. And more due to gig economy, a lot of people are going to unregulated, unstructured workforce. They're going to multiple jobs. They're not a steady payroll employees. So there's a need to rethink how to create a pension system for this kind of workforce will define the next 10, 20, 30 years of our economy. That's the one big area. The other big area is the insurance gap. By some estimate by World Bank and G30 report, but it's going to create an annual gap of $200 billion of insurance gap, which needs a very new thinking of how you to re-architect the micro pensions side of the pension, micro insurance side of the insurance coverage. So a lot of startups or fintechs are going to focus on the insurance side. They're going to create new models, new way of delivering insurance coverage plans. And the third sector which will grow is the sustainability side. In fact, in this FinTech festival, 30% of our content was for the sustainable and climate change side. Why fintechs are going to play a big role there? We have seen that for last 2 years, the whole green finance bond is suffering from 3 basic problems. hard to monitor, hard to measure, and hard to mobilize fund, because if you don't monitor and measure, how are you going to get funds? And there's a whole supply chain when it comes to green investment, which has to be monitored at every stage. So this is where technology is going to play a big role. IoT devices, big data, blockchain, they're the new technology available to start putting out there. If you're financing an asset which needs to be long-term monitoring, you need a lot of this technology to be there so that you can measure this long-term finance in the green side in a sustainable way. And that's another for a $1 trillion market waiting for fintechs to grab. So with this trend of where we started, where we are moving, and we are going to move forward, fintech seems to be taking a great leap forward. And to sum up, in my view, that there will be a market correction in the construct of fintech because a lot of fintechs by design are small. They are started by founders who thought they will unbundle a piece of the financial sector and do a great job of that and start going to market. But it seems to be unsustainable because you still need to have a stack-like thinking where for every person there's a need for a checking account, there's a need for a financial product, the need for a financial services, and you can't sell them bits and pieces. They need to have a stacked kind of construct. So what you'll see a lot of consolidation happening. A lot of small fintech players are going to come together and start building very comprehensive set of banking services or financial services, which we now call as the digital bank licenses. That's the reason why Hong Kong issued a digital bank license. Singapore is in the process of issuing digital bank license. These digital banks are going to build a consortium of fintech companies coming together, and that will define the future construct of financial sector. This will be the future banks, which we'll call as the digital bank.
Thank you, Sopnendu. That was very interesting because you've defined the future construct of the fintech sector. And the three areas that you've talked, one over micro pension, as you talked about, one didn't realize that it was going to be so large, the insurance gap. And then the most fantastic thing is the sustainability, which you think is going to be a $1 trillion kind of a market. I think that's much thought for the audience, for market corrections and other things that may. Now, the third speaker that we have this evening is very distinguished. We have Anne Lochoff. Anne works with the UNDP as the Global Center for Technology, Innovation and Sustainable Development, very much up her street. And she's very distinguished in the sense that she was also the chair and business advisor in the New Zealand Trade and Enterprise Beachheads Network. And in 2016, Anne was named one of the top 9 global influencers of tech innovation in cities by Inc.com. That's really blazing excellent track record. And your floor now.
Checking that. Thank you for the segue. That was perfect. Just a quick overview. We're obviously UNDP, which is part of the United Nations, but we are the largest development agency in the world. We have presence in 170 countries. And of those, 140 are in emerging markets. So it's a massive network. And then within that, we have our country offices, but we have what we call global policy centers. And we are one of 5 global policy centers, but we are the only one focused on technology and innovation based in Singapore. And we chose Singapore because of its ecosystem for innovation and technology that we would like to harness to take out to our developing markets. And particularly, there has been a launch of a new digital strategy within with the UN. We actually had our chief global digital officer out for the FinTech Festival so that he could actually see what was happening here, because he joined in August and is mandated to bring in digital processes and transformation to the way the UNDP actually operates and runs its programs. So here at the center in Singapore, we have 3 key focuses. One is sustainable agriculture, one is sustainable finance, and the other is digitalization of societies and cities. So I'll sort of err towards our sustainable finance area, because really what was started 2 years ago by the Secretary General is a committee on digital financing for the SDGs, because essentially the UNDP has a framework for the way we can improve livelihoods, which is the Sustainable Development Goals. And this is what we would like to put into the way people look at sustainable investment and sustainable finance. But how do we fund that? How do we make that happen? How do we make that real in people's lives? So this committee has been convening for the last year and a half, and it's gone across major stakeholders in terms of heads of banking institutions, governments all over the world, looking at how digital finance can actually help the SDGs. There's been phenomenal progress and research on this area where there's a lot of tech. And I'm glad that the insurance industry was brought up, because the areas of geospatial tech is now coming into the area of insurance to help smallholder farmers actually be relevant and mitigate risk when it comes to the insurance sector. And so this is a phenomenal piece of tech that has been there for a while, but has now come down to the level of affordability, so that we can actually translate that into emerging markets where we can create products for smallholder farmers. So this is how we're bringing financing for the SDGs. But we're also bringing new ways of looking at investment. So we've also launched SDG Impact, which is out of New York, which is looking at tools and frameworks for how to look at validating investment frameworks that incorporate the SDGs. Radically, we have done a lot of prototyping out of Armenia, and we've launched our first SDG fund, which is quite unique for the UNDP, because we can't actually fund anything as a neutral UN body, but we've actually managed to do this so that we can create a fund to support companies that are focused on the SDGs. We've also launched our impact accelerators to bring the concept of impact into FinTech and financing. And we've done this in Denmark, we've done this in Armenia, and we've done it in Indonesia. And we'll be bringing a cohort of companies from our Indonesia Impact Accelerator to Singapore on the 28th of November, so that you can actually see how this is being done and the types of companies that we're actually helping with these frameworks. So we're really introducing tech, impact, and innovation all together, much needed in terms of mobilizing the SDGs, mobilizing sustainability, but also impacting climate change, because as soon as you are supporting the SDGs, you're setting yourself for a purpose-based business. And this is, you know, I was so enthused by the youth team earlier and the sort of focus areas and their need for purpose in their business modeling. We've got all of those tools. We've set them up. You just need to engage with us and bring those to your businesses. We're really keen to see that.
Thank you, Anne. This is very interesting that you've been able to integrate, you proposed to integrate technology, impact, and innovation. But I think the most interesting part of your presentation was the fact that you've been able to set up a SDG fund, which is probably first time for UNDP. Yes, and well, she has not indicated the size of the fund to us, but hopefully
they're aiming for 40 million. It's small, but it's a start.
Oh, then that's a good amount to start with. Well, we've had these 3 presentations. Now, I think we'll open it up to the audience for any questions that you may have to ask any one of these panelists. I think the floor is open. Yes, please, go ahead.
I have a question for Mr. Mohanty. My name is Siddharja, and I'm also a technologist here in Singapore, not in the fintech sector. You mentioned that there is this need for kind of stack effect, stack structure for fintech startups to actually make sustained impacts in the financial services sector. And that you mentioned that there are going to be these digital banks licenses that are going to be giving out, which will help companies to come together and try to compete with the incumbents. The big banks have a lot of money, and they've already started collaborating with, as you said, fintech companies. Do you foresee them having any significant advantage over these so far unstructured, not working together, not unified, group of innovators, trying to compete with big banks that already have multinational markets, that already have the structures in place, and are now trying to start technologies? Is that like a level playing field?
Okay, thank you. Yes, there's the incumbent. Maybe I have to take a step back. What has happened again back into Asia here, there was an architectural shift by the Asian banks, the way they construct themselves. If you go to any bank, most systems are designed like a single box. And that's why they're extremely inefficient. What, due to a lot of policies, MA's own policies around APIs and microservices, made banks to shift to microservices, which is like a bunch of pipes, which allowed them to plug in many fintechs to digitize their own processes. In that process, a lot of banks, like our own DBS, become highly digital, and they are more cost-effective, and they're now part of this whole new digital economy ecosystem. Now, if you think of, I think your argument is that, or your concerns are that what happens, this bunch of fintech come together and they build a consortium and they get a digital bank license, will they have a disadvantage against digital banks of the incumbents who are getting to digital process? My view would be, I hope these digital banks address the need of people which are unmet till now. That's the reason I laid out my future 3 points. If you are going to play in the insurance market, go to the micro-insurance sector. Because you are digital, because you don't carry legacy, because you don't carry the weight of existing cost structure, you will have a far better ability to serve in a better cost structure small insurance services, small pension services, maybe play some role on climate-linked loans, which can be used as a way to increase your loan portfolio. Let me give an example. A lot of you have heard the bank called WeBank in China. When I met the CEO of WeBank, he made an interesting observation or interesting point. WeBank runs at a cost of sub-dollar tech cost. What that means, every transaction WeBank does, it costs them 30 cents. Against a bank which perhaps runs at more than $100 per transaction. Why WeBank runs that cheap? Because they run a highly agile technology architecture which has no data center. It runs on a whole set of microservices. The whole services of WeBank are a plugin of many fintechs trying to provide high-value services. By doing that, they brought down the cost structure of the running a business to less than $1 per transaction. So I think that will be the strategic advantage this digital bank will have in the way they run their business. And if they address the unmet need, these are the new area of opportunity, I think there will be a level playing field there.
That's very interesting. But what were the security aspects of amalgamating so many?
I think there's an argument made that by putting so many API services, cloud-based, will it cause information security or what you call outsourcing risk? My answer is that now we have better technology to monitor these plugins. In fact, I would also, in some sense, argue they're better than a box. If you are running a system which is a plugin, if in your house, if the fan doesn't work, the whole house doesn't collapse. In the banks, if the fan doesn't work, the whole box collapses because they're all single, highly connected, highly linked. So there's a distributed risk in that form that if one thing doesn't work, you can plug out and get a plug-in of a new one. So there's a balance, there's an argument there, yes, by increasing the surface area, you have increased the surface area of attacks, cyber attacks, but there are better technology available to deal with that. But that's a new model. You are democratizing your services, you are spreading your cost structure. It is much more democratized in terms of services being aggregated provided by different parties. No more enterprise, large IBM single system structure anymore.
That's a very interesting thought process. I'd like to ask Ajay if he would like to explain something about your regulatory sandbox, because there's a lot of participation that will be involved in it. Would you like to elaborate?
So we have followed approach to have two sandboxes. One is innovation sandbox, in which anonymized data, there's a lot of trading data which is available with exchanges, there's data available with the depositories. So it will be an anonymized form to entities who want to participate. They need not be registered with SEBI, so they're not registered participants. And they come out with solutions. So that's one way of dealing with innovation sandbox. Other thing is regulatory sandbox, which we issued a discussion paper and we'll finalize it by another 2 months, I think by December. There it will be to the regulated entities who wish to do some innovation in other regulated sectors within SEBI's domain. And that will require some dispensation to be given under the regulations to those entities. So that is the second phase which we are planning. And we take it quite seriously. I mean, to give you an example, like blockchain technology, which everyone is talking for almost, I think it's been in capital markets itself for 2-3 years at least, if not earlier. There obviously is vested interest and resistance. I don't want to really name, but if no intermediaries are required, then clearing corporations and depositories, they themselves become infructuous. So there is a need to actually learn from innovations as to what is the possibility, and to have a capacity build up even in a regulator, so as to see what is the downside, so as to see why these technologies are not being adopted, are there vested interests. So we are very keen to further both our innovation sandbox and regulatory sandbox.
Thank you. Yes, Anne, please.
The UNDP is doing a very similar thing. We're actually launching 60 accelerator labs in all of our emerging markets. This is to shift the 60 years of experience of engaging with government and having a very good handle on policy. But Achim Steiner has come in as new leadership to UNDP and gone, why don't we leverage that knowledge and engage corporate, startup, the innovation sector, and bring that into the knowledge that we have, because we can't do it alone anymore. And bringing in that technology knowledge that we have, together with our market intelligence that we have on the ground in emerging markets, is a fantastic combination that we can now bring to our corporate partners.
Vinod, the regulatory sandbox, if I can add some clarification to what Ajay spoke. In 2016, we started the sandbox program. There are two kinds of sandbox, as Mr. Tyagi spoke about that. There's a regulatory sandbox and there's an industry sandbox. What does regulatory sandbox does? The kind of candidate who apply to that have to meet 3 goals or 3 barriers. Whatever idea they have got must challenge the existing policy. They must clearly articulate this great product we can't launch because this policy is coming in between. The second barrier they have to cross, it is for people's betterment, not for individual personal corporate goals. And third, it has to be innovative. We had an interesting data to share with you. Almost 90% of applicants couldn't make it because they couldn't clear the 3 barrier. Out of the remaining 10%, 5% drop off because they could not sustain. One of the criteria we put in regulatory sandbox that after you graduate, it will be a level playing field. You have to get the full regulation applied to you. And you have to have a production ready system. We were left with 5% of the applicants to actually get into regulatory sandbox. The 95% who didn't make it, we created for them an industry sandbox, which interestingly Prime Minister Modi launched in Singapore FinTech Festival last year. We call it API Exchange, where they can experiment with the banks. They can do a lot of things where there's no regulatory barrier per se. There's one example I want to give in the capital market side, very recently happened, so that can give sense to everybody how sandbox really works. We recently approved one candidate who does fractionalization of bond. In fact, in partnership World Bank, where the bond is a large ticket size, very hard for retail people to buy a bond. So can we fractionalize the bond and issue on a blockchain and get retail customer buy for single bond fractionalized to small tickets, and they can buy. The whole process can be end-to-end in a blockchain. And when you issued that regulated sandbox license to this particular company, we had one big regulatory question or risk outstanding to be resolved during this sandbox period. What happened? This small company goes bankrupt. But we knew that that's a risk, but we allowed that to go on to the sandbox. But there's a constraint being put around, so there's no market risk. Because we allowed it to happen, during Singapore FinTech Festival, this company tied up with Northern Trust, a custody bank, who's willing to build a matching blockchain platform and can do the full custodial services of the fractional bond. Now, no, if you are not allowed this company to have gone to this, you would have never got the next partner. So this sandbox allows this discovery of partners who may not be there if you don't bring into the market. So sandbox helps in market discovery of partners, innovative partners, and that in the process you may end up creating a new market structure for a kind of bond which never existed.
Very supportive. I think it's in incubating the kind of innovations that are required. Okay. Anything from the audience? Anybody? Oh, yes. The lady there, please.
My question is for Mr. Mohanty. Globally, poverty has gone down, but when we look at the gap between income and wealth divide, it has increased. The poor are poorer, the rich are richer. So I'm wondering, how can technology be used to provide financial services to the poor and the ultra poor to help them break from the poverty cycle?
Good question. Very difficult to answer, but let me give an attempt. When FinTech came, if you go back to history of FinTech, they were highly focused on improving the payment services, because payment was a real barrier for small or people below a certain income level to participate. And they created, if you go every country, Africa, Asia, thousands of FinTech players are playing a remarkable role in moving money, small wallet operators. That has really changed in Africa, the M-Pesa story, all these things. After the payment problem was solved, quote unquote, there was a shift by the FinTech companies start doing microcredit. They looked at the bills, the basic the transaction they're doing on top of the money they're receiving. It created a credit process for them to do an alternate credit models to extend credit. I think now, last 2 years, they started talking about micro savings or micro savings, which is the third step in the whole wealth build-up. And hopefully, after they solve the micro savings part, they'll start offering micro banking product, some small unit trust, a small low value unit trust, which allows a small wealth growth in the small income holders. My sense is that as we build a continuum of micro payments, micro credit, micro services, micro pension plan, micro insurance, and micro wealth product, you will see a new continuum of product being developed for this below certain income level, and it's a long journey. And the reason why FinTech can do a better job, because they are cheaper, the cost of operations are far more cheaper than the incumbent, they're more agile. One thing I would end my note here, as we do this thing, public goods are coming in place, like India, in Singapore, in Africa. They're building public infrastructure which will make it further easier, like they're building the National Digital Identity Platform, the payment rails, the data consent rails. Once that comes into a mainstream infrastructure of many countries, these small FinTech players will going to ride on that. That will further bring down the cost of customer acquisition, and that means that they can offer the services in a much expanded way to a larger community. I think that's my current thinking around how they'll solve that problem, but it is still a long way to go.
Yeah, but it's headed in that direction. It certainly is, and I think that's a huge solace for the poor. Would you like to add on this?
The impetus actually behind our Impact Accelerator program was exactly that there was so many of these accelerator programs, but not enough focused on, FinTech for emerging markets, for smallholder farmers, for the people who we're really trying to help. So this is why we actually rolled out this program, was to use the innovation ecosystem to look for those products that would actually help those that aren't actually being serviced by the larger sort of systems.
In fact, we did a program that if the migrant workers are remitting back money to account holders who are women, there's an end point, more credit being offered to the recipient. So there's a very intelligent way of extending these services to a larger community beyond poverty. More gender inclusion is also part of this whole game.
And the recipient being transborder?
Sorry?
The recipient being transborder also?
No. So the idea is that if the migrant workers sends money to a male receiver, so there's cross-border. It's a cross-border. This cross-border program where the recipient has to be a woman, and if that money, because a lot of time the recipient of money of migrant workers are not women of the household, and they don't have ability to improve the life of the family. When men receive money, they don't spend the right way. But women spend money on health, on education. So the migrant workers sending money back to home is better to be received by women of the household rather than a man.
It's not a technology issue that much. It's a policy issue of having the right intention and making the right type of structure and program. Technology will not be a handicap in doing such things. I'm very sure of that. But you have to have the right intention and a will to do it.
The point is that with the blockchain, it protects from getting corrupted.
No, that's true. Yeah. But still.
Yes. Yes, please. I think that will be the last question. We'll wind up now. Otherwise, we'll have Sitara threatening us soon.
Since we have Mr. Tyagi on stage, I have been the beneficiary of a crowdfunding campaign in the past. I've run a successful crowdfunding campaign. I would like to do more. Crowdfunding, crowd investments are part of FinTech. I think we're not talking about that kind of thing right now. But as the chairperson of the SEBI in India, what do you see as the future of these things, these new phenomena, crowdfunding, crowd investment? They aren't as structured or controlled as traditional securities or traditional investment vehicles. So what role do you see SEBI playing in these phenomena of the future?
So I don't know how successful crowdfunding is in Singapore, but you can't really draw similarly to crowdfunding, say, in the West and in a country like India, where the crowdfunding in US, say, depends on, interpersonal relationship, people believing in the idea, people having faith on the reputational risk of the issuer, and everyone knowing that, this is a project which is worth considering. If you want to transplant that in a country, I would say Indian scenario, and there are very many crowdfunding, the funds being raised through such platforms, there are serious investor protection issues there. And the larger issue is that if you are collecting money from more than 200, or you make an offer to more than 200 persons in a year, then that is actually you need to have, it has to be, listing has to be done as per the company's law in India. So more than 200, you are not allowed to do that. Otherwise, you have to get it listed. And within that, you have to have a strong investor protection issues. So it's not that you can't have a mini exchanges in the country all over or not regulated at all. So that will not be, that has been actually examined and not really found that successful. Less than 200, you can go ahead and do it. Sorry? Yeah, that is true. But so long as they're doing it at their own risk and they're informed investors, we can't stop people from doing. But if the platforms are in the jurisdiction within India, and so they have to follow the norms. If As I said, below 200 investments in a year, you can do it. Beyond that, as a concept, we don't, I don't feel that it's an activity which could be effectively regulated. Thank you.
I think we'll have any closing comments that, Anne, would you like to? Anything that you feel you need to wind up with?
I think, some of the tech that was mentioned earlier was obviously AI, which is sort of leading the way in terms of where FinTech is going and where financial services is going. But from our perspective, the biggest sort of aspect that entails is trust. And I think, that's not a tech aspect, that's a policy and a thinking perspective that we need to add to the conversation as we're looking at AI and bringing AI into financial services, and then thinking about how to inculcate the SDGs in that thought process.
Vinod, I would like to end with an example. Just to give a sense how this world has evolved, there's a company that does Know Your Cow. Know your customer, there's something called Know Your Cow. Why they do Know Your Cow? Because 70% of world's food supply are from marginal farmers. Their only collateral is cow. And during crisis, they can't even take a cow to a bank, says that this is my collateral, give me lending. There's a company which has put an IoT chip on the cow. It is on the blockchain. It is writing a credit point to the platform. Banks in Rwanda and Myanmar are trying to experiment to extend credit based on the blockchain and the Know Your Cow chip on the blockchain platform. That explains how fintechs are innovative.
Very interesting. That's really very interesting. I think on that note, we need to end. I'd like to take this opportunity to thank Anne, Ajay, and Sopnendu for a very interesting session. Thank you very much, and to them.